will start first with Mark Welch. Okay, he's going to talk about some of the resources that we have and to get to know more about markets and what he's doing. Then we will have John Robinson talking about cotton market, and last David Anderson, who is going to talk about beef cattle markets. So, Mark, whenever you want to start, it's all yours.
All right. Thank you very much, Pancho. Again, thank you for putting this together and keeping this program and momentum going. Always a pleasure to be with y'all today, and thank you all for tuning in, and those that will be watching this later. I'm going to take a little different take on my presentation this month. Basically, still be the market update, but in the format of resources that we try to provide on a more regular basis between these meetings. And some of you may be aware of the newsletters that we put out. But in case you're not, I want to make you aware of that resource. And if there's some ways that you might utilize these or facilitate you and your programs and information that you work on, just make you know what's available and how we might could help and support that. This is a view of my feed grain outlook that I try to put out every Friday. I do one for wheat as well. And what you find in those weekly reports is an update on the recent market situation, around crop progress and condition reports, grain markets updates around the state of Texas. I do have a section on what's going on in outside markets, more macroeconomic issues that I think influence the farm economy. And then I put a marketing plan here at the end of this, just as a sample of what folks might do or what a marketing plan looks like. And so I'll just kind of walk through that road pretty briefly here this morning. Again, just kind of make you aware of the resources that are there. Obviously, there's some verbiage around what's going on. The big report that came out last week was the update of the supply and demand situation in the WASDE, the World Agricultural Supply and Demand Estimates. And the biggest changes for corn, here are the actual numbers that came out in the September WASDE around planted acres, harvested, supply issues, demand, price estimates. If you'll look at in terms of numbers of bushels, the biggest change to the WASDE was in what happened to the 23 corn crop, not the 24 corn crop. Even though the yield is higher, now estimating a national yield of 183.6 bushels per acre, just an outstanding number. If you look at a national average corn yield, that was up a half a bushel this month, which did raise production about 39 million bushels. But the biggest change to the balance sheet is we used more corn for fuel and exports in the previous marketing year, and that actually lowered the amount of grain that we carried over to start this year. So the supply actually went down by 55 million with those adjustments. So actually the supply actually went down this month, even though we did raise the corn yield estimate. No changes at all on demand numbers for the new crop corn year, this 24 crop that we've now just started harvesting nationwide. It did lower slightly, this critical number right down here. This is I use the stocks use ratio. Of course, I'll report that, and that's a number you hear quoted a lot, and it got a little tighter. In other words, the carryover stocks relative to how much we use goes down, and that typically is a price supporting mechanism. But the level at which we're carrying over that corn, the number I like to refer to is days of use on hand at the end of the marketing year. How long can we live next year on the crop that was left over from last year? And right now we're looking at about a 50-day corn supply. And that's down slightly from the August estimate. It was 50.6. Now we're at 50.2. And I'm going to put that number in context here in just a minute. And even though that actually went a little tighter, you would expect that to support prices a little bit. USDA did actually lower the estimate for the season average farm price, the national price paid to all farmers for the entire marketing year. That's now standing at $4.10 a bushel. So if you go down then through the rest of the newsletter, you'll find some charts and figures related to that information. There's a look at putting this year's corn yield in perspective. That dotted line, if you were increasing yields just over time in this trend line from 1980 and project that out through 2024, you'd look at about 181.5 bushels. And again, USDA has us now about 2.2 bushels above that. So that just kind of puts in perspective just how good this corn crop really is projected to be this year, even though in Texas we're struggling a little bit with our corn yields. And then month to month, how do the September numbers compare to August and compare that through the marketing year? We had a reduction in beginning stocks. We had a increase in production, and these both sides of this equation have to balance. And so our ending stocks went down just a little bit. But you can see that through the course of the year, kind of what's been the tone or the theme of the corn market, and look at those production numbers. We're not back up to the record crop we had in 2023, but month to month, that number is just kind of creeping up and up a little bit. And we're really not doing too much on the use side. Exports are up a little bit, but again, that's the theme of this year's corn market. While we're seeing prices like they are right now, I would attribute that primarily to these month-to-month numbers that just indicate, this corn crop's just getting bigger and bigger every month. Just kind of go through a few more of the other slides that I think kind of tell the story. There's our overall corn use. You can see feed use is the top use of U.S. corn. Fuel comes in second, and finally exports and food, seed, and industrial use. And then the gold bars will be our ending stocks. Note how ending stocks over the last several years have been getting higher and higher and higher. And that's certainly a price depressing movement to see that carryover of grain moving up. Always interested in Dr. Anderson's comments around with feed use being our number one use component, what he projects is going on in the livestock markets. To the degree to which are we going to get back to these relatively lofty numbers of just under 6 billion bushels, given what's going on, with cattle on feed and rebuilding, the herd, with the poultry industry, with the pork industry, how those things combine to feed this number here. Fuel use, it seems difficult under current projections that we're going to get above that record level of corn for fuel that we hit in 2017. Of course, that depends on gasoline demand primarily. We do export ethanol, and that's a good market outlet for us. And actually, ethanol exports are higher this year, but it's all about gasoline demand when it comes to ethanol at this point. Now, unless we can break into that jet fuel market, the sustainable fuel for jet fuel, that would certainly be a game changer. But at this point, it seems difficult to see a lot of growth in the ethanol sector just because of vehicles on the road that are getting so much more efficient. We're not drastically increasing the miles that we drive. And there's a greater percentage, although it's still very, very, very small, of vehicles on the road that don't use gasoline at all. And so, again, I think those are some of the patterns and trends that we're fighting on that. And then this is the real price determining or revealing slide that I'll include every month. And that is the relationship between that days of use on hand that we were just talking about and the season average farm price over here on the y-axis. And when we see our higher prices, that's related to these lower numbers of days of use on hand. And in the corn market, this 40-day threshold is critical. When we drop that number below 40, that's when we're in these more profit-generating price scenarios. When you get that number above 40, that seems to be a real depressing impact on price. And if you look at where we are in 2024, $4.10, about a 51-day carryover, 51-day carryover. We're kind of back where we were in those years of 16, 17, 18, 19, when that season average farm price was between $3.30, $3.40, and just below $4. So fundamentally speaking, that's kind of where we ought to be with the kind of carryovers we've got going on in the corn market right now. Just a few other things right quick. We do have some other charts and tables around world corn production. The current estimate for corn carryover is a 92.3 day supply. That's down from 92.9 last month, and 92.4 a year ago, 94.4, 94.5, 93.4. We've just been in a very static pattern when it comes to the global carryover of corn to use. There's our corn production number. Not a record crop this year, but pretty strong, relatively speaking. The biggest corn producers in the world, of course, the U.S. is still dominates the world corn market, but China is showing they're kind of coming up strong in second place. Brazil is certainly our number one competitor in the export space, and they've got not a record crop this year, but relatively strong production. The EU is down. Argentina is down slightly from last year, but a relatively strong crop. Those 2 billion bushels coming out of Ukraine, Argentina, Ukraine jumping ahead there is down from since the war began, but still, just anything coming out of Ukraine just is incredible to me, given what they are working against. And then, of course, the other major producers of Southeast Asia is kind of a clump, and then Mexico would be the kind of the top 8 production areas of corn around the world. And then this then puts in perspective again that critical days of use on hand at the end of the marketing year. Look what's happening in the U.S. market is where that pile of grain at the end of the year is getting bigger and bigger and bigger, and we've crossed over that 40-day threshold. So now we're creeping back up on these relatively high carryover years of 16, 17, 18, 19. And so moving ahead in 2025, it's going to be very important to try to get some assessment of, are we going to keep pushing that number higher, or will be some factors in place that might actually trim that size of that pile of grain. But the U.S. has been going up. The world has been coming down. So this is total foreign days of use on hand. Just take the U.S. out of it, and that's been coming down. But the U.S. is such a dominant force in the world corn market that the U.S. alone is enough to compensate for the decline in the rest of the world, and it creates a very stable days of use on hand number for the world. And so I think that's a critical price influencing signal, is that that's not a particularly high number coming in at this 92, 93 days. You have to go back to 2013 to find a lower number, but we've been relatively stable over the last 4 or 5 years. And I think that gives the market a lot of confidence. It doesn't create a lot of uncertainty in the market if it feels like it can be assured that, that number is holding pretty steady. I've included that same chart in my wheat outlook this month, and wheat does not look like that. Wheat, we have the U.S. coming up. But you take the wheat out of the world market is getting tighter, and it's still coming tighter. Total foreign is tighter because the U.S. doesn't dominate the world wheat market like we do corn. And so you see that kind of influence. Crop progress and condition ratings. Again, we're talking about a record corn yield. This chart would indicate that's an index. The blue line would be the average index over the course of a growing season. That black line, as you can see, it's running higher than the blue dotted line. That means we've got a better crop condition generated by the index that we calculate. But about 2/3, the worst we've done this year is about 2/3 of the crop being good and excellent. That's a really good corn crop, even though, again, we struggled with that number in Texas. Zoom in on that a little bit. The red line is now your average or your normal crop condition index, which starts out about 372, drops down to about 355, and then we close a little bit higher. The green line was last year's corn crop, which at the time was an all-time record high corn yield. And then this is where we've been running this year with the blue line, or the dark line there above. And why we've got a yield estimate above trend is because we have condition ratings above average. And so it kind of points us in that direction. A few other things that if I find that are interesting around crop production and progress, I think this was particularly of note. This is generated a website by Iowa State University. It's called their Environmental Mesonet. And we've talked about corn conditions in Texas being struggling. It's interesting to note that we're now at 75% harvested for the Texas corn crop. This chart goes back to 1985. We've never had 75% of the corn crop harvested on September the 8th before. These X's indicate the day of the year that we hit 75% every other year. And then the line drawn across September the 8th. You're not going to find a white X on the left side of that line. So this is the earliest we've ever harvested corn in the state of Texas. And generally speaking, that's not favorable for yield and production. If it's drying out and harvesting early, that probably indicates some kind of problem during the growing season. So run across things like that. I'll try to include those in the newsletter.
Hey, Megan.
Charts here.
All right, how about you? Hang on just a second. Let me, okay. I'm on AGECO update, but anyway.
All right, I'm going to jump on down here to some of our outside markets. Had a big inflation report that came out last week. The Fed is trying to get inflation down to a 2% long-term level, and we're making progress. The CPI was down to 2.5%. The producer price index down to 1.8. And I think both of those numbers will give the Fed more confidence to cut interest rates when they meet later this week. And so I think that certainly give us perhaps a boost to the U.S. economy. Changes in the CPI, factors that are helping keep price levels low. Food at home up less than 1%. Energy was down 7%. Apparel is up just a fraction. What are the factors that are pushing us higher, keeping pressure on inflation higher? Shelter still running high. Transportation services, medical care services, food away from home. If you have somebody else fix it and serve it and clean it up, yeah, you're going to pay a little more for that. And so just kind of a picture of kind of what's driving inflation in the U.S. economy today. Then we'll slide on down. There's some other charts and tables around the U.S. and global economy. This is helping us on the export side. Look what's happening in the U.S. dollar. This is just the most recent quarter, July the 1st through last Friday. And when the dollar gets weaker, that makes our exports more affordable in foreign markets if you're paying in U.S. currency. So that certainly helps us perhaps on the export front. And then we wrap up the newsletter, and I have my marketing strategies. The first thing I include in that section is I like to put in something about the seasonal tendencies in prices. And the red dotted line is that 21 seasonal price index for the December corn futures contract. And then the black line is the behavior of this year's 2024 December corn futures. And it's kind of textbook. You'll find that we did hit the peak a little earlier. It'll be interesting to see, have we hit the bottom, the low in the market earlier? I think that's going to be a major area of interest as we unfold the last few weeks here of the growing season. This is the same seasonal price chart, but overlaid the 2014 contract. 2014, we were coming off record high. And we had a corn crop, the good and excellent percentage fell below 72%. So a really good corn condition ratings all through the year. And we hit the early, kind of like we did this year. And with that 2014 pattern, kind of line up a little more closely. But again, have we hit the bottom or do we have another leg to go lower? That's going to be, I think, of key importance to our marketing outlook here the next few weeks. Two things to wrap up with. There's a marketing plan. So through the year, if I lay out a plan at the very beginning of the season, I've got my 2025 plan is built, and this is how my plan is played out in 2024 for corn marketing. And I include this at the promptings of one of our district economists in Stephenville, Jason Johnson, said, well, show us how to do this stuff. And so I stuck it in the newsletter. And if nothing else, it's just an example, a pattern, a template of what a marketing plan kind of looks like. And I really appreciate, I hear back from producers that put that, look at that marketing plan, and they let me know when they beat it. They let me know when their marketing plan is better than mine. And I like to hear that. I'll throw this on the wall and give you something to shoot at. That's great. I want to hear what you're doing and what's working for you and your producers. But that's why we include that in there. Oh, excuse me. And then we'll jump down. And one other thing, there's the 25 marketing plan. Gotten a little bit done back when corn hit $5 back in May. Again, back kind of that peak in that market. Got a little bit done. The last piece is upcoming reports and events. And whether they're around USDA reports, macroeconomic reports like the Federal Reserve meeting this week, when the CPI comes out, stuff like that. Two things I want to draw attention to. Number one, we do have a master marketer program coming up in El Campo, October 1st and the 2nd. It's a 2-day event, and we're going to cover risk management issues around things like budgets and break-evens, building a marketing plan. That will be meeting in El Campo, October 1st and 2nd. Any extension employee or county agent that wants to join us, you're invited to enjoy that for free. Just let us know you're coming. And just so we can account for your meal. We'll make sure we've got a plate for you at lunch and a notebook for you for the materials. But any employee with AgriLife that would like to come and just see what these workshops are about, to see if you might like to learn for your own information, but also if you'd like to do one of these in your area, we can bring this to your town. And so just know if that's something you'd be interested in, and we'd be glad to accommodate you to join us in that. We'll have these, and appreciate that. There's 2 ways to sign up. The best way to do that is the website. If you just search TAM you're going to get to that website, and we have a link to the registration page. And we'll get you signed up there, or just email our office, and we'll walk you through how to do that. I'm going to be out for a few days, but Carolyn Gleaton will get that email, and we'll make sure and get you signed up and that you're on the list. But we invite you to join us in El Campo. Our goal is to have a couple of these this winter. Been talking to Andrew and Dee Dee up in Lubbock and Amarillo. Going out there for Jeff. If we'd like to do something maybe in San Angelo, we could circle back over to other parts of the state. So if this is something interesting in, I hope you keep that on your radar. Another program they have coming up that I'm highly involved in, it's a professional development for farmers and agribusinesses called the Executive Program for Ag Producers. It's intense. But if you have some big producers that are dealing with issues of succession, their farm operation has gotten complex. We started out with a few hundred acres on this farm, and now we're thousands, tens of thousands, and we've got a fertilizer dealership. We've got a interest in a John Deere house or other equipment. We've got a seed business. We've got a trucking business. Some of these businesses have got really big, but have our professional skills and abilities to manage a business that size, have they grown or kept up? And so that's how we have this program to help folks maybe get up to speed. It's like a micro MBA program for farmers. It's a 2-year program actually to complete the whole thing, but it's a week at a time. And so if you have interest or questions around that, certainly would invite you to reach out to our office. We have a website, TPAP, if you're interested in that as well. My contact information right there. Shoot me an email. We provide you all the information around the direct links for the flyers, for the registration materials, and my email is there on the screen. And of course, hope I'm not too hard to find, and be glad to take any questions or comments.
Mark, what happens? What
any
if
of this stuff?
somebody
With this newsletter, if it would help you out to use that. Yep, go ahead. I'm sorry. I think I stepped over somebody.
No, I was just going to say, if somebody wants to receive your newsletter, how do they get it?
Oh, that's a good question. Shoot me an email. Doesn't cost you anything. Be glad to add you to the contact list, and you'll get that every week directly.
And is it an attached file, or is it a link?
Yes. What you will get is a Word document or a PDF, and it'll look just like I'm showing you here today, and it'll be an attachment to an email. And so there'll be a brief introductory comment around that.
I think we lost Mark.
Yeah, I think he had bad reception.
Well, anyway, if there is any link we need to send, we will send that afterwards, or send us an email, if you have any questions, okay? So, John, do you want to start with your presentation?
Yeah, does that look good?
Yes, it does.
Okay, I'll mention something about my online newsletter resources at the end, but just a quick market update first. Cotton prices are still sort of at a bottom, which I'll show you in a little bit, is kind of the seasonal low. Like corn, we've slumped to our seasonal lows, and we did it earlier than usual, but this is where we've been since January. We were flirting with 85 cents, and now we're bouncing around 70 for a couple of different reasons. The first one would be selling pressure from speculators. I'll draw your attention to that green downward spike. That is a record, at least since 2006. That's the biggest short position held by what we call hedge fund speculators, people that follow trends and buy signals and charts, and they do whatever they can to get an edge and try to anticipate whether the market is going up or down. And if they think it's going up, they'll buy it. If they think it's going down, they'll sell it. And when a whole bunch of them are selling it, then you get these downward, basically it's an accumulation of short positions over long positions, and that selling pulls the market down. And you can see that this little red movement here is that drop from 85 cents to 70. And it's heavily influenced by the selling behavior of these people. Now they're doing this to make a profit. And so if something was to make the market go up, like, a hurricane or something extremely bullish was to happen that would drive prices up, well, then these people they'd be losing money. They'd be losing profits on this speculative bet for downward prices. And they'd probably buy their way out of their position, or they take their profits, which would mean buying. Either way, there's a lot of potential buying if these guys ever get out of this position, either taking profits or getting scared and wanting to cut their losses or whatever it is. They're going to have to close this long green spike. They're going to have to close it out by buying. And that buying actually represents a potential rally that could happen anytime, really anytime this fall. And it could happen dramatically in a short period of time if something was to hit the news that made these people want to get out of this position in a hurry. But so far, they're still building a short position, and that involves more selling, and that's why we still are, just fighting to get back over 70 cents. So that's sort of the speculative market dynamics for why we have low prices. The fundamental reason why we have low prices is I've got circled down here at the bottom the supply and demand numbers, which the most current ones of which again, like Mark said, are posted by USDA and what they call that WASDE report, World Agricultural Supply and Demand Estimates. We had a WASDE report last week, and it kind of whittled away at the production that's here. 14.5 million bales is what they're now projecting. They were projecting 17, and then they cut that to 15, and then they cut that to 14.5. So they're kind of whittling away on the size of the crop. They're cutting exports too. This is the export number, 11.8 million bales. And the bottom line of it is 4 million bales of carryover or 4 million bales of leftovers. And that's bigger than last year. Last year was tighter, a little over 3 million bales of carryover. So if projected carryover is going up, then that's a fundamental reason to explain the low prices that we have. Now, it's not drastic to go from 3 to 4, but it's not bullish. So this would be the fundamental reason why I'd say prices are low. And that's sort of these guys are sort of amplifying that, or they're throwing gasoline on the fire. There's the fundamental reason for low prices. There's sort of the reason that we have prices at 70. It's because of this extra bearish selling by them. So, of course, I could spend an hour talking about all the different moving parts in the supply and demand column here. There's a lot to be said about what will be harvested and what the weather is. And, we're in the middle of a rainy harvest season across the entire cotton belt, and we'll have to see how that plays out. It'll probably degrade quality. I don't know that it's going to hurt production that much, but we'll have to see. There's parts of Texas that are normally dry that are a little wetter this year, late in the season. Will that translate into harvested bales? Probably will in a few places, probably won't in others. We won't really know until October, November, December. So there's some time for some of these numbers to be worked out. And there's uncertainty about the demand side too, and the growth of the economy, and whether the Federal Reserve will cut interest rates this week or next month or what have you. And frankly, the election could have some bearing on the demand expectations for the economy and for cotton. So again, we'll have to see. And I've summarized some of those comments here. We've had a whittling down on the production side. If it stays the same, we'll wind up with maybe 4 million bales, which is, it's not terribly bearish, but it's not bullish in any way. So I think it justifies the prices that we have. And I'll again reiterate that point that because there are so many short speculators in the situation, we could have what traders would call a short covering rally. If something scares those speculators, or if they just all decide to take their profits, there's going to be a bunch of buying to get themselves out of that short position. And that buying could push the market up a dime if it was to happen. We could be at 75, 78, 79 cents if we had a short covering rally. The only trouble with that is it wouldn't last very long. It'd probably run its course and we'd still be at our back to our harvest time lows, which is what this chart is showing you. Like Mark's thing for corn, this blue here is the seasonal average, 20-year seasonal average of December cotton prices. You can see that on average, we tend to peak in the first half of the year, and we tend to have harvest time lows in August, September, October, November. And the red line is the 24 futures price, and it kind of anticipated the normal seasonal pattern. It had the slump a month or two early. It's hit the lows, and we, like I say, we might have a short covering rally in here, but I think what we see is pretty much what we get. We may have a rally into the upper 70s, but I bet it comes back down to the lower 70s before it's all said and done. We have to watch and see what the Federal Reserve does. We have to watch and see what happens with the election. If the market is anticipating a Trump victory and a GOP Senate and House, well, that might give a new Trump administration the ability to implement some of the proposals they've been proposing and talking about, which include widespread tariffs. And from an agricultural standpoint, having other countries retaliate and putting tariffs on our cotton exports and soybean exports and other exports would be a disruptive thing. If that was to happen, I think that would hurt the demand side. It would probably weaken the cotton market if all of this was to happen. So again, we'll just have to see in the market. We'll be anticipating these outcomes. This is my contact info, and I hesitate to call it a newsletter. It's really sort of an encyclopedia, but it's right here in the middle. Here's you can click there yourself, save that URL, or you can send me an email. We'll put you on a list, and we'll email you a reminder. It's usually on Fridays when I publish material for this online resource, and I'll send you a reminder email that says, click this link, and the updated newsletter will, you can find the updated newsletter. And let me, while I'm here, this is what it looks like. Pancho, I don't know if you can hopefully see that.
Yes, we can.
Okay, well, this is what it looks like. And it's basically, there's a little market summary. If all you want to read is a paragraph or two about what the market did this week, just go to the front page and I try to summarize that. And then I've got an encyclopedia of other stuff that over the 20 years I've learned that I need to keep track of that. I need to read that report once a week or once a month, and I need to check on USDA numbers, and I need to check on exchange numbers, and I need to check on some industry numbers. So I try to keep track of all the things over the years that I've learned might be important. And so I've got them under all these little sub menus. So if you ever have trouble sleeping at night, just pull up this website and read it down into the sub menus, and it'll put you to sleep. But it's more info than you probably care to look at. But it's got updated graphs and updated data and updated links and such. So anyway, that's what I've got to share. I'd be happy to answer anybody's questions or hand it off to David if he's here.
Any questions for John? John, I do have a question. And here in this area from Texas, cotton doesn't look very good, dryland cotton especially. Do you think those, the harvested acres that USDA have there, do you think might be lower than that? Is that accurate, or is,
That's a good question.
Is that accounting for what's going on in Texas?
It's the way that USDA gets their data now. They used to go out and count bulls in the field and do stuff like that, but now they rely heavily on two sources. They survey growers and ask them, what is your yield situation? What is your harvested acre situation? So it's based on survey work. It's also, they're getting into satellites, I don't know how extensively, but they're flying, either getting satellite data or flying drones and looking down and taking what they collect from that and feeding it into crop models and making estimates. Between those two, I think they're probably anticipating lower harvested acres in your world and in the high plains. and maybe a little bit in South Texas too. They're anticipating that. Whether they nail the actual number, I think it may take them a while. The ultimate data source for cotton production is Jennings data and classings data, because every bale is classed. They take a sample, they send it to the classing office. That's a count. That's a reliable count of the number of bales. So sometime in about December, they'll have a pretty good idea about how many bales have been classed, how many bales have been gin, and they'll refine that production number. It could be lower than where we are right now. It's hard to say. And these kinds of years, sometimes where it's wet and crops are late, if they're not destroyed by late season rains and hurricanes, we'll get unexpectedly large production coming out of the Mid-South and the Southeast, which compensates for losses in the drier parts of the Cotton Belt. That happens all the time. So, we could have a surprise to the upside in terms of production too. So we really just have to wait and see.
Excellent. Thank you, John. David, are you here?
I'm here.
Good.
I tell you what, I had Doolin, I assume you can see that okay. I had Doolin Zooms today, or Doolin's Teams, so I jumped on the first one for 15 or 20 minutes and then got over here. So thanks for letting me be late, Pancho. I kind of called this sliding summer prices because that's certainly what we've had in the cattle market. Really starting right at the end of July, first week of August, we really took a big old decline, particularly on the futures market, and it really kicked off with fed cattle prices. At that moment in time, really, I think much like last year, we had a situation where I think we had a lot of traders just looking for a reason to sell. And at that moment, it was a big thing in the news to talk about, oh gosh, there was a bunch of people yakking about potential for recession. And really none of the stuff they were talking about has turned out. But that certainly gave, I think, traders a reason to start to really dump the futures. And so, futures and cash, when we're talking livestock, they're not the same thing, but they're certainly related. And if we look at fed cattle market, and I'm using here the 5 market weighted average. So it's, Texas, Oklahoma, Western Kansas, Nebraska, Colorado, Iowa, Minnesota. So from Southern Plains to Northern Plains, and you can certainly see that decline that we've had over about the last 6 weeks, where we've gone from about $1.90 to almost 180. I think some sold on Friday in some markets at about 180, 181. And we're basically right back where we were a year ago with prices right on top of a year ago. So, I think it's worth pointing out this big slide. And while, we might have kicked off some changes on the futures market, I think one of the overriding things that I think some people really, I think it's been slow to dawn on some folks, and I'll show you a couple of the charts, but I think we ought to think about this certainly in the context of larger fed cattle beef supplies than a year ago. We just simply, between steer and heifer slaughter and weights, we're producing more fed beef than we did last year. Now, the decline, if we looked at beef production would be lower than a year ago, but it's all on, and slaughter anyway, but it's all on the cow side. We're sending fewer dairy cows and beef cows to market. We're down double-digit percentages from a year ago on the cow beef side, but we've actually got more fed beef. So, whatever gyrations happen on speculating side of it, we're trying to sell more beef than we did a year ago. And we look at it and think, well, why are prices struggling? Well, heck, we're trying to sell more beef than we did a year ago. And so that shows up in our fed cattle market. If we looked at the choice beef cutout, we've actually had over the last 3 weeks cutout values that are below a year ago. Again, this idea that we're trying to sell more beef and quite honestly, more choice beef than a year ago. Because while we've increased our pounds or our production of fed beef, We're now hitting to the point where we've got 1 or 2 percentage point increases in choice beef grading compared to a year ago. So we got a little more fed beef, we got more choice, and so we look at this market, this value that's calculated from the primal cuts. Gosh, I'm not sure from a supply standpoint, it ought to be a big shock to us that that price may be below a year ago because we got more product to sell. I think the other thing I would point out is whether we're looking at the fed cattle market or the choice beef cutout, these prices are still pretty high. We may have touched a little below a year ago on the box beef cutout value, but that's still pretty high prices. And certainly on the fed cattle side, we've got pretty high prices. So, thinking about that in the context of supplies, the response of feeder cattle, in this case, 700 to 800 pound feeder steers, kind of southern plains, we've got prices for the last month right on top of where we were a year ago, with lower fed cattle prices, and particularly lower futures market prices for when these cattle would finish. Now, I think the thing that's helping us is that we continue to see reports of a heck of a lot of corn being produced and low feed prices, really for the next few months and coming year. I think that's supporting us. At the same time, the fed cattle markets pulled us back a little bit. So our feeder cattle prices have certainly come down a little bit over a good $20 over the last month or so. Again, that response over time to what we've seen on the fed cattle side. Now, let me go back to this cutout for just a second because I think it's worth pointing out. I think I did a month ago where we looked at what the middle meats and the steaks and the end meats, the chucks and rounds and some of that, and we continue to see this dichotomy of, I think, some struggle on the middle meats, but higher prices on the end meats, the chucks and the rounds. So I think that's still playing in this market where we've got some different directions. But the thing I would also point out that we ought to remember is, here we are, I guess, this weekend will be the last day of summer. We'll start moving into fall. And our beef markets kind of move seasonally into that as we sort of change the different cuts that people want at different times of the year. So we're really in this, the cusp of changing seasons, changing demand patterns, just seasonally. And I think that's also reflected in our box beef cutout. So let me point out a little bit on this supply idea. And so my solid blue line on this chart is 2024 steer slaughter. This is fed cattle fed steers coming out of feedlots. And it really lays over very nicely with this price decline. We've got more steers going to slaughter than we did a year ago. And in fact, we've been pretty close to a year ago, almost the entire year. So more, more steers anyway. Just the way it works out. We've had a fewer fed heifers going to market, but remember, steers weigh more. So in terms of pounds, we're producing plenty of beef. And so if I combine that increased steer slaughter with these dressed weights, I mean, this dressed weight thing is pretty shocking. We sat there at 920 pounds. When we would normally seasonally see declining weights, we've had weights sitting up there just like that. And we've made our turn to seasonally higher weights as well. What's driving this? More days on feed. So we're putting on more weight that way. Much cheaper corn helps. And just the way it works, it's cheaper to put on more weight, and we do that. We've got them on feed longer. We're putting on more weight. These pounds are increasing, and the simple way, what I'd tell you is if you got a calculator handy, take that 930 pounds, which is basically where we are now, divide that by a dressing percentage. I'd just say 0.635, and that gives you what the average live weight was. And those are some pretty dang big weights. And at this pace, we would be headed towards new record high weights this fall. So we're really adding to the tonnage or pounds of beef being produced that's offsetting, I think, some of our number of head going to market. So we're really getting into plenty of beef out there. And I think that's, from a fundamental supply standpoint, that's pretty important in keeping a lid on where the beef side prices have been going. Now on Friday, we got a cattle on feed report that's going to come out. I've done my pre-report estimates and on marketings, I'm down 3.5%. So the way we report this to the various news media outlets that carry it is we always talk about it in terms of this month as a percent of a year ago. So I got marketings at 96.5% a year ago. So lower marketings, but what I've highlighted here with this daily average is we actually had one more what we call slaughter day in the month. And slaughter days, we typically think about 5.5 days a week. And you might think about it as Monday through Friday, and Saturday, you're kind of finishing up what you had, some half-day kills, And so when weekends and holidays fall are pretty important in this, and it turns out we had one less day in August than last year. So I've actually got our daily average marketings up a little bit compared to last year. So we're moving these animals through packing plants and headed to more beef production. So I do expect the headline number for marketings to be down, but if we dug in a little deeper to this daily average, we're moving cattle. Placements, I've got placements down 3% from a year ago. So the way we reported is 97. I think it's worth really checking out this placements. Look at the long term, what our normal trend is. We really see placements increasing in August, September, and October. We start to get a lot more spring-born calves going to feedlots, driving that October number higher. And we've got more of our heavyweight yearlings, summer grazing from around the country, really helping to push August and September higher. So I do have placements down a little bit than a year ago. And I will say, too, of the market analysts that do pre-report estimates, I'm on the low end. We've actually got a couple of analysts who think placements are going to be a little higher than a year ago. So, moving that seasonal trend, higher placements, but on balance, I've got the raw numbers. I've got more placements than marketings, which gives us a cattle on feed for September 1. I've got 100.3% of a year ago, so a little bit more than a year ago. So what that also ought to reinforce is this idea of the number of fed cattle that we have on feed in total being a little bit ahead of a year ago. Now, we could break that out in between over 120 days and this 90 to 120 day window that we actually have fewer than a year ago, and then the 90 days are bigger than a year ago. So, we can get some timing issues of when a lot of these placements happen. But if we keep our eye on the ball, I think the main thing is a few more cattle on feed than a year ago, which ought to tell us, we're going to have ample supplies of fed beef on the market in the coming months. And so really our smaller cow herd, fewer calves being born in total is, really, while that should be pulling us down, we've still been placing heifers. We've got increased imports from Mexico, and we've got we may have pulled some animals ahead in this. I do think, I think it's going to be kind of interesting over the next couple of months as we look at dry conditions, prospects for winter grazing, and things like that. Does that help? Does that end up helping us boost the number of placements in cattle on feed at the expense of some winter grazing programs? But it's, we may be a touch early for that yet. So I think we'll see as we go. Sounded like I got on late, but sounded like Mark and John were talking about some of the CPI data. I want to highlight really a retail price comparison. This data for the blue line is beef, red line's pork, dotted line is broilers, chickens. And if we look at these retail prices, This is the data that comes out in the Consumer Price Index and reflects meat prices. And the thing I want to point out particularly is, you know, we can talk about some record high prices, particularly on the beef side. But as we look at this, I'm more interested in this chart as we think about relative prices for consumers. And what I think this would show to us is that beef continues to become relatively more expensive than chicken, meaning that gap is getting wider. And that becomes pretty important in terms of how we think about demand and consumer behavior, that people switch. And this, as beef becomes relatively more expensive than chicken, it really highlights the opportunity for consumers to do some switching around. Now, I might say pork too, but if we had more time, we could talk about pork's struggles. I think on the demand side, I think it's more telling to think about folks switching from beef to chicken. That can go on, and relative prices certainly support that action. And I think this really highlights that pretty well. I went back to this goes back to 2009, so it goes back 15 years, and you can see a pretty dramatic widening over time in those relative prices. Yet, through much of this period, we've talked about beef demand growing, that consumers continue to buy it, that consumers continue to see it favorably, and we keep buying beef, even in the face of these relative price changes. So I think this is kind of interesting to think about going on. I got one last chart, and I thought I'd say something about lamb prices. Slaughter lambs, 60 to 90 pounds. The thing I think I would highlight a couple of things out of this chart, and it is true. I have averaged kind of a Colorado, Texas, and South Dakota markets for this slaughter lamb market, kind of across the board, to get a kind of a decent reading on this, kind of across a broad area of the country. But I think a couple of things should jump out to us. One is certainly the seasonal pattern, with increasing prices headed towards Easter and declining after that. This year's prices have been very much in keeping with what we would normally see in kind of our seasonal pattern. I think the thing that's striking to me is that prices have generally remained higher than a year ago, even though we're producing more lamb domestically than we did last year. So if we've produced more, we're importing more, we've got larger supplies on our market. And what it really jumps out at me is that we've been able to maintain higher prices than a year ago in the face of larger supplies. I think that's really a positive, and maybe even kind of indicative of maybe recapturing some consumers' dollars a little bit on the lamb side. So I think that's pretty positive. I was going to have one more chart, but I got so mad at the Cowboys yesterday, I forgot to make it. I really wanted to highlight eggs. You may have noticed or may have seen something. I think one of the things we'll be talking about more, or you'll see some more headlines and stories in coming weeks, is really egg prices that have jumped dramatically higher over the last few weeks. And so, if we look at that, what's going on, and in fact, in terms of some weekly average prices from USDA, we've been well over $4 a dozen. That's up more than $1 just in the last few weeks. Really some quickly rising prices. I would highlight, really two parts. One is fundamentally, we've got fewer layers, and HPAI has certainly been taking a hit on the layer side of things. So we're producing roughly 3% fewer eggs than we did a year ago. So if we've got 3% fewer layers and 3% fewer eggs, that's probably a recipe for higher prices, particularly this time of the year as we're getting closer to fall, and we get into a lot more kind of holiday baking demand, fall baking demand going forward. So I think that we may see some pullback on those really high prices, because that's what typically happens. But you might see some more stories about that. And so keep in mind, we've got about 3% fewer layers than a year ago and about 3% less egg production. So if we keep that in mind, I think that gives us a pretty good reason for why we could have some higher prices, particularly with that seasonal demand. So with that, Pancho, that's my last slide. I'll see if I can stop sharing.
Thank you,
I think
Dave.
I made it.
I appreciate it. Let me stop recording.
Anybody got a question for me?